Welcome, and thank you for tuning into KBRA podcasts. We cover topical research discussion, industry commentary, and more. This is the first of a two-part conversation with Dan Daniello, co-founder of the Carlyle Group. In this episode, Bill Cox, Global Head of Corporate, Financial, and Government Ratings at KBRA, talks with Dan about how ESG considerations are impacting private capital and how ESG fits into the history and evolution of the market. Stay tuned to learn more.
Hello, everyone. My name is Bill Cox. I manage KBRA's Corporate, Financial Institution, and Governments Ratings teams, and I am so pleased to be here with Dan Daniello, who I do not believe needs an introduction. His work and positive impact on the private markets and increasingly on a broader stage is well known. Dan co-founded Carlyle and is currently non-executive member of the board. He has served on the board since 2011 and was chairman from 2012 until 2018. Good morning, Dan. It is great to be with you.
Great to be with you too, Bill.
I know our listeners are looking forward to hearing your thoughts about the current trends in private markets, particularly given the lens that you offer, which is someone who helped create and shape this industry. So let me start there, Dan. Tell us how Carlyle and private capital as a whole has evolved since you co-founded the firm in 1987.
Well, and back in the 80s, private equity really was sort of a cottage industry, to be coming right down to it. There were only half a dozen or so major firms back then. If you call them major, they weren't even that big. And it was basically what I would call a bootstrap business, which was buying an asset, financing it, and having the cash flow of that asset pay down the debt. And when you exited, the amount of debt you paid down, in effect, was your equity return on top of the equity you invested in it. So it was less of a building and growth strategy and more of a financial timing and engineering strategy. And of course, during the 90s, the industry really got a shot in the arm by virtue of the fact that many pension funds, both corporate and public pension funds, were looking for ways to earn higher alpha on their investments because they were seeing the wall of their future liabilities on pensions coming forward and realizing that they had to increase the return on their investable capital to be able to fulfill those obligations. So therefore, more and more of the pension funds were allocated toward alternative investments away from fixed income and such. And so that provided an opportunity for private equity firms that had prepared for that exigency by building a solid back office that could meet the fiduciary obligations of their pension fund investors. That was really, really important. And one of the keys to Carlyle's success was first 5 years, we put 100% of our profits into investing into fiduciary systems of reporting, control, and things of that nature. And so we were the beneficiary of not only the move toward more alpha allocations from pension funds, but also the idea that pension funds would go toward fewer firms that had that kind of infrastructure that could serve their reporting, control, and fiduciary needs. And sort of the decade of the 90s basically were tailwinds with a strong bull market for almost a decade, with available financing at reasonable costs, and with the opportunity to do more than time the asset, rather to get deeper into the strategic direction to rehabilitate, restructure, refinance, and to drive growth. And so through most of the 90s, you saw this increase in, let's call it, hands-on value add type strategies where private equity was not only bringing in money, but also bringing in skills. And so much so that toward the end of the 90s, private equity firms were able to offer to entrepreneurs that had growing companies or private companies, family-owned companies, smaller, mid-sized companies, an opportunity to stay private longer because we could help them with their M&A. We could help them with their balance sheet financings and things of that nature. And so there wasn't this issue of I have to go public to get the kind of capital I need to expand. We had increasingly, because of the track record of private equity through the 90s, the confidence of investors to put more money behind us, and therefore for us to put more money behind and grow, develop the businesses that we invested in. And of course, when you got toward the end of the 90s, sort of the technological frontier started to expand exponentially. First with the dot-coms and the technology companies, TMT companies, and then went with higher level of technological capability with the onset of digitization and so forth. And so that was the next wave of development. And today we have a situation where old companies can become new companies by virtue of their ability to adapt new go-to-market strategies and new procedures and growth strategies that are driven by digitization and deeper knowledge of their client base, deeper knowledge of their customers and suppliers, and deeper knowledge of the macro trends and how to fulfill them in the market. So here we are today.
That's an amazing journey, Dan. And I know that our funds debt rating team, in their due diligence of investment funds, has begun to see all sorts of continued evolution. And one of the things in the now over 100 ratings of GPs and individual funds debt transactions that they have seen is the emergence of ESG issues as becoming absolutely consuming. It seems that ESG factors are impacting both public and private markets in unprecedented way, and yet the breadth of that impact continues to accelerate. So two questions. In the context of that history that you just described, can you recall any equivalent individual trend that impacted markets in this way? And recognizing this is still all evolving, we'd love to hear what Carlyle's current approach to ESG might be, and what are the key areas of focus right now?
Okay, well, thinking about the prime movers with respect to impacting the market, and I would start by saying the evolution of the internet and technology was a tremendous impact because of the democratization of finance, of information, of communications, which all led to much more broad-based access to the market and knowledge of the market, and even provided a platform on which new business models were created, including new asset classes like cryptocurrency. So that's one, the internet and technology. The second would be regulation and government oversight and things of that nature, where you have a wave of far-reaching legislation like Sarbanes-Oxley, like Dodd-Frank, like the stipulations with regard to highly levered transactions, all of which impacted our firm and private equity's ability to do business. The third, I would say, is related to ESG, and I would call it the father, so to speak, or the mother of ESG, and that is the movement ever so slightly and then increasing over time from shareholder capitalism to stakeholder capitalism. And in other words, taking a broader look at the P&L and saying that not only does the bottom line matter, but also all of the lines in between matter, including employees, including the communities, the institutions, the countries. In effect, being a good citizen where you do business and how you do business became much more important. And now, of course, when you overlay on top of all of that the issues of climate change and of social issues, then you have a very robust definition of ESG that covers everything from stakeholder capitalism through the environmental evolution of the planet, as well as the social evolution of the people on it. And so what do we do at Carlyle? Well, we haven't specifically done what I would call an ESG fund, but rather we think ESG is laced across all of our activities, all of our products, all of our geographies. Remember the old expression, when in Rome, do as the Romans. It's important to be a good citizen in every country, in every city, in every state that you do business in. And that inures to your benefit. And of course, the environment. It does have an impact. It will have an impact not only on energy and the energy transition, but also the standard of living that we are enjoying in the United States and in the world. And so also climate does impact the ability of firms to operate. You consider things like water levels, sea levels, weather patterns, the insurability of assets. These all come into play with respect to environment and such. Also, in the social side, of course, the new mantra is, actually it's not new, but the ever increasingly important mantra is diversity, equity, and inclusion. And of course, we've done a lot of work there too. And as a matter of fact, there have been studies even internally at Carlyle where we have been able to observe that the boards that are on our portfolio companies, those boards that have more than 30% minority membership actually have a higher return than those that don't. I don't know whether that's coincidence or whether that is just the ability to get a broader base of opinions and life experiences into your investment decisions and in the way you operate a company. But specifically, we do have an ESG committee that we've put together. It's headed by our main risk manager. And we also have put together a 4 billion plus fund that actually lends and against ESG related businesses or projects and has the capability of reducing the cost of debt to that project based on achieving ESG objectives that are set in advance of that financing. So we do have a very, very integrated approach. And we were one of the first private equity firms actually to publish what they call the Task Force on Climate-Related Financial Disclosures. We actually have gone through control companies and done a carbon footprinting. And I'm happy to say that we are very, very close to net zero there. And so it's on top of our minds. And this is over and above all of the savings that we try to bring toward our operating companies with regard to energy. And it's also related to all of the transitional energy producing capabilities of our energy companies from historic generation to renewables. And so we do have, in fact, a renewable energy fund, where most of the activity right now is in developing wind and solar. So, we are pretty much broadly across the entire footprint of ESG at this point, and it's top of mind and included in all of our investment decisions.
And that covered so much territory, just brilliant. There are a couple of phrases there that will not be forgotten by me, but stakeholder capitalism, the impact of diversity on board decision-making and governance. These are brilliant concepts and well described. You mentioned renewables, and I think rightly alluded to the fact that climate change and related measurements of carbon and the regulation that's here and is coming are among the things that might be most challenging for any kind of company or organization in coming years. You mentioned a focus on renewables. Does Carlyle have any specific focus on risks or sectors that it won't engage with right now? And how do you see that evolving?
Well, I would say there is one area where we sort of avoid, and that area is thermal coal mines. We do, however, and we don't invest in coal-fired plants, but we would invest in a coal-fired plant to convert it to a cleaner form of energy, whether that be clean coal or whether that be changing it to a natural gas-fired power plant. But I would say that generally speaking, our portfolio in power is sort of natural gas power generation. And most of our growth is going to be in the area of wind, solar, biomass, and things of that nature. So I would say, it's an investment in a natural gas generation plant really in this day and age it depends on what kind of asset it is, whether it's a base load asset, which would give you a low return, but a stable return until there are alternative energy capabilities there. And when there are alternative renewable energy sources, you still need what they call peakers. And those are generally gas powered generation facilities. That is to say, the sun doesn't shine all the time, the wind doesn't blow all the time. And when that happens, the peakers kick in to provide that base load. Now, the alternative to peakers would be battery technology that can store electricity and then redeploy it when it's needed. But to date, the technology is not there at the level to fill the demand. And so, peakers will be around for a long time. And we view the power industry and the energy industry as a layered industry. And that is to say, there are going to always be a need to have a basket of alternative types of energy producing assets. That's the only way you can diversify against changing nature. And, let's start from the bottom and say that nuclear energy will never be super big, but it is the cleanest. There's no question about that. It may not be the safest, a lot of people think, but it is very, very low costing source once it's up of energy. And then on top of that, probably the diminution of coal and oil burners, and also some diminution of natural gas power plants, but they'll still be around for a long time. And then on top of that comes all of the alternative energies, which I would say most people's estimate, they could probably provide something on the order of 25, 30%, maybe even a little bit more than that of America's energy needs. But they're never going to be at a level where they can fulfill all of the energy needs. So we have to have sort of a basket of alternatives to maintain flexibility and to maintain the safety under different conditions.
It sounds like the bottom line of what you described is that the fact that some investors may be ruling out certain sectors or energy production capabilities creates opportunities for others who see the role of some of these assets in the longer term.
Yeah, I think that's right. I mean, of course, everyone has their own risk return profile, and they also have their own strategy with respect to the environment. And, I would say that technology is not just limited to renewables. They're now producing much cleaner natural gas powered plants than they used to. And so the effluents and the carbon capture is a lot more efficient today than it ever has been. And as a matter of fact, the United States is way, way ahead of most other major industrial countries when it comes to clean air. I mean, they're still building coal burners in China. And what can you say about that?
Yeah, absolutely. The data in that regard, it seems for every ton of carbon we don't emit, it gets emitted somewhere else. So it's a real challenge for the world stage.
It is.
Thank you, Bill and Dan, for your insights today. Tune into the second part of this episode, where Bill and Dan will discuss the drivers behind the growth in secondary strategies and the increasing role and impact of private credit and direct lending. In the meantime, visit KBRA.com to access all of our ratings and research for free.